Hi traders, in this lecture we're going to be going through risk and how important risk is in regards to your trading career. Now risk has got to be one of the most important things to consider when starting a live account at the beginning of your trading journey. You need to have your risk management in place even before you think about putting any real money into the market. No matter how great your strategy, win rate and risk reward is, if you do not have a solid Forex risk management strategy in place, you could end up losing everything. So what is risk management? Risk management helps to maximize any profit while minimizing any losses. A common quote in trading is, let your profits run and cut your losses short. Now what this essentially means in regards to your risk is when you know you are wrong in the market, get out of the trade. Now let me just show you an example of how that looks in the charts. So let's just flip to the charts a minute. Okay, so let's take a look at the charts and let me explain to you what I mean when I say cut your losses short and let your profits run. So I'm currently looking at the Euro USD. Now again, I'm going to be going through the charts in later lectures in the trading view section and in another section where I go through the charts in a bit more detail. So don't worry too much about what the candles may mean, but let me just give you an example of when you're wrong, get out the market. So we're on the Euro USD, we're on the hourly charts. Each one of these candles is a 1 hour time frame. So let me just fast forward. So price is moving up, we're running up to this resistance level here, breakthrough, and then we're waiting for the pullback to buy this up and look for a long position. So here's the entry. We have this pin bar here, we enter the market. Now we have this tool here again, which I'll go through in the trading view section, but what this means is this level here is your stop. So if price hits this level, you can be taken out of the market, and this is your target here. And this is a risk reward ratio of 1 to 2. So let's say, for example, you have a £100 trading account, you're risking 1% on this trade. So that means if price comes down and hits your stop loss, you're going to lose £1. And if price goes in your favour and hits take profit, you're going to win £2. So let's say your strategy is that you require a 1 to 2 risk reward ratio before you even enter the trade. So for every pound you risk, you must make £2. So fast forward a few bars. So now we can see price is not going in our favour and will be in red at this point. Then it shoots up. And then look here, price just misses our take profits by how many pips here? By 5 pips. So we just missed our take profits. So when I say let your profits run, you should never take profit unless it hits your take profit. So if you know in your strategy you need a 1 to 2 risk reward ratio, you shouldn't be taking your profits early. So this is what I mean by letting your profits run. Because if your strategy dictates you that you must have a risk to reward ratio of 1 to 2, then you need to let your trade play out. So let's continue forwards with this. So now you can see prices start to move to the downside and it's getting closer to our stop. So this is what I mean by cut your losses short. So at this point, you're in this trade, you don't want to widen your stop, because if you widen your stop, you're going to be adding more risk. But if your strategy dictates you that you only need to risk 1% per trade, you don't want to be extending this stop loss, because then it'll go from 1 to 2 to 3% risk, and that's how you start blowing up your account. A couple more bars, and then if this was a live trade, we would have been taken out of the market. So if you'd left your stop where it is, that's a good thing, because you've hit your stop loss. So now you know this trade is no longer valid and you were incorrect with this trade. which is totally fine. As I've said before, professional traders are not right 100% of the time. Depending on their strategy and risk to reward ratio, they could possibly only need to win 20% of trades to still be profitable. But again, I'm still going to be going through this in a later lecture in regards to risk to reward ratios. So that's just a quick example of just sticking to your trading plan, cutting your losses short, and you're letting your profits run. So let's dive back into the lecture. Now, as a beginner trader, I initially recommend you only risk 1% per trade. So let's say you have a 10k account, you short the euro against the dollar. If that trade does not go in your favour and hits your stop loss, you'd incur a loss of £100. Not the end of the world, is it? Using this 1% method helps with that. Now, using the 1% method can help with a few of the following things. So 1, not blowing your full account with a handful of trades. A lot of beginner traders, when they first start out, will open, say, a £500 account, risk £250 on one trade. Now that's 50% of their account. Even if that first trade does come in for that trader, then the next trade they take, they may get all excited and think, hey, I'm going to risk more. Trust me, this is how you go broke very quickly. So 2, only risking 1% helps with your psychology. Only losing 1% of your account is hopefully not going to put you in a bad state mentally. You are less likely to revenge trade or get too emotional if you only lose 1% of your account. Losing is part of trading. Not even the best traders have a 100% win rate. Losing trades is a cost of doing business in trading. Let's say you own a TV shop and a customer is returning a faulty TV. This is going to have a negative impact on your business, but it is a cost of doing business. In the long run, you know only a small percentage of TVs are going to have faults. This is the same when trading. You're definitely going to have losses. You need to accept this as a trader and accept this will help you with the psychology of training with the correct risk management, win rate and risk to reward ratio. You'll be profitable in the long run, and managing your risk is part and parcel of this. So number 3, the 1% rule helps with losing streaks. So let's say, for example, you know your win rate is 40%. Now let's say we have 100 trades, for example. We know out of those 100 trades, 40 of them are going to be coming in as profitable. But let's say we have, out of the 100 trades, the wins are not going to be random. They could hypothetically be 60 losing trades and then 40 winning trades. But if you don't have the 1% risk management in place and you risk, say, 10% per trade, you're going to go bust well before you even get into 30 trades, for example. So this is why it's so important to only have 1% of your account at risk per trade. Now, as you slowly optimize your trading strategy, you may, for example, notice on a Tuesday you're winning more than versus a Friday. So you could potentially, on a Tuesday when you take a trade, up your risk to, say, 1.5% or 2%, and vice versa. If you know on a Friday majority of your trades don't come in, but in the long run you're still profitable, you may want to half that to 0.5% risk per trade. Now, a good example of this is when people card count at casinos. So they will just bide their time, and they know when they're on a hot streak they're going to up their risk, because if they up their risk then the reward is going to be greater. Now let's say you're going short on the Euro GBP and you're going short on the Euro dollar. So you're short on the same currency. So you're short on 2 pairs that have the euro in. So the best thing to do here is not risk 1% per trade. You want to split that out and have 0.5% risk on both trades. Again, this helps minimize your losses and it keeps risk on the low side. So at the end of the day, limiting risk enables you to stay in the game and continue trading when things do not go to plan. As I've stated before, you're definitely going to incur some losses in trading. This is just a part of trading and it's something you definitely need to get used to. So thanks for listening, and I'll see you in the next lecture.